All right, stocks finished a pretty up and down week, about as flat as you can be, considering how volatile the week was. We had a pretty big range from high to low. Again, coming after the FOMC meeting, and then the day after, where we dropped even more. And then Friday, we had a little bit of an up and down move of a couple percent intraday, and on Friday before we closed. Kind of reflection of the up and down that we saw pretty much all week. While we've been pretty low relative to a lot of these moving averages. So the market's trying to, I think, figure out a low point here in the short term, in the near term, to get that near term line up on the market forecast indicator. I think that's probably where we're headed here over the course of the next week. We're going to break down why, and I'm going to show you, but I'm also going to show you that don't get your hopes up too much in terms of this being the low point. And we'll talk about why. And as bearish as we are, and there's a lot of just bearish sentiment, extreme levels, and all of this and all that, there's one indicator in particular that still screams at us that we are not in capitulation mode right now. We are not anywhere close to capitulation mode. In fact, we can compare our current levels to a prior period where we were in capitulation and the market rallied right off of that. So we're going to look at why this is not like that. No matter how bearish it actually does seem, why does it seem like we still have more to go? So we'll break that down. And then our trade idea is a stock that has pulled back. It hasn't really consolidated, but it's been on its own little pullback, and looks like it might be bouncing up and maybe failing at at resistance. So we'll talk about how to trade that with a big gap in volume and moving averages to fill in if we are to move to the downside. So let's go ahead and get started. Today is May the 8th, 2022. This is the market outlook from marketscholars.com. My name is David Settle. All right, well, let's start off taking a look at the market forecast on the S&P 500. So you can see the down day that we had did not close below yesterday's low. Got another long lower shadow, very similar to how we started the week. So we started the week with a long lower shadow. We finished the week with a long lower shadow. Probably will end up getting one again Monday, tomorrow morning. We ended up closing almost right at the cluster. In fact, we did have a cluster at the lows where all three lines were in the lower reversal zone. We were more than 7% below the 30-day moving average at that low point. Now we still finished 6 below. It's still very low. It's in the, for the past year, it's the 10th percentile. So, you can see this is about as low as we got both these other instances right around the last FOMC meeting. And so you probably expect it will probably come up this week into these areas, these Fibonacci resistance levels, whether it's this green 38 or the brown 38, whichever one will probably come up into that zone. You can see we were already there on Wednesdays after the FOMC. We got up there at the high of the day. So obviously it's not out of the realm of possibility whatsoever. Remember, you're going to get big moves when you're below moving averages. You get your biggest moves, and considering that we had a 3% down day followed by a 3% up day, and then another 3% down day, you'll expect that we'll get another 2 to 3% up day relatively soon. If not Monday, we could have it on an intraday basis on Monday. So that's kind of what you're seeing right now in the market forecast chart. Intermediate lines, the near-term line you can see did get into bullish territory. So if you look at the last few near-term peaks, this one, and then this one, they've been progressively lower, right? 1, 2, 3. These have been pretty long near-term declines for a bearish move. We tend to bounce quicker than that. I expect it will probably bounce a lot quicker than that on this one. I don't think we'll stay in pink on the blue line for very long. We'll probably bounce back out of it. By midweek, we'll probably be back out of it and moving up. You can see the intermediate line is moving up. It's barely above 20, so that's why you get the light green shading, even though we're way below that red line, the falling moving average. The momentum line is low, but not extremely low. Again, that's the product of long lower shadows. So getting long lower shadows is a good sign. That means the bears can't finish the day down. The bulls come in. The bulls have been coming in this area. You can see that lower shadow, that lower shadow, that lower shadow. So this is the area right around 41.25 or so. anywhere below that, the bulls tend to come in pretty quickly and bring it back up. So it appears to be the case. The momentum market sentiment line's dropping and is not quite below 40 again, but it's almost there. The intermediate line is below 40. You can see when the intermediate line's below market sentiment, you tend to stay, down. You hit that brief little dip above it there, but you tend to stay down until you get above it. Once you get above market sentiment, you feel pretty good about things. So there's a pretty good chance we actually do something like this again, where you probably come back up above it briefly, then turn back down. We get a run up to the moving average, and then turn back down. Right? This is almost the exact kind of pattern I expect that we'll see here this week. Right? I expect that we'll get a pretty decent week. If you look at the weekly market forecast for the S&P, you can see short-term sentiment still really bearish. So for the near-term line to be below the 10th percentile once is really oversold. It's a very good opportunity for a bounce. We've had it now 3 weeks in a row that it's been below the 10th percentile, the near-term line, just barely 7.74 this week. So pretty good chance, the momentum line too, pretty good chance that we'll bounce out of that, especially with the monthly market forecast. This last April, we had the momentum line dipping to extreme lows, and that's pretty bearish, especially also to get the near-term line. The near-term line, you can see the near-term line, it's rare, and the month's not over with. We just barely started, so take that for what it's worth on the near-term line. But you can see, like, we haven't had the near-term line this low since the bear market low point, and we didn't even really get it that low then. Right, by the end of the month, we were, the near-term lines ended up just barely below 20. So the fact for the near-term line to be below 7, that's the lowest it's been in the last 20 years. In fact, you've got to really go back. Let's go back to the beginning of when it became a 500 stock index. Zoom all the way. You can see again, there's that May and June that were really bearish in 2010. The bear market low point, a couple of dips below the 20th percentile. Right here, we got to 13.36 during that bear market drop. We were already in a bear market at that time. We had our bear market failure here. Actually, it was over here. But we had another failure, and we just kept going down. So that was during that bear market. There's the 1998 long-term capital management dip, a really bad month there, brought the near-term line down. There's 1990. We had a couple of really bad months. It brought the near-term line down to 14. And again, you can see 1982, 1981. We were in a pretty small bear market, but then you have to go all the way back to the 70s, late 70s, to have the near-term line this low, to finish the month this low. So that's not normal, and especially considering we're not really that bearish. I'll show you with the VIX here in a minute. We're just as bearish as we are. We're not so bearish that we're that we're washing out, right? Let's take a look at the weekly, or the Nasdaq 100, the market forecast. We did finish the week, the week with a daily cluster on the market forecast, 9% below, which is in the, again, that 6 2/3 percentile. If you take a look at its weekly chart, you can see we also finished with a weekly cluster, and that's pretty rare. And I think Brandon pointed this out on Twitter. Last one that we got was at the end of the 2018 decline, that correction. Now keep in mind, so that would have been, December the 20th, right before Christmas. The Christmas Eve was that Monday the next week. But to kind of show you where volatility was at that point, to show you just how not bearish we are. So that last day right there, that was Christmas Eve. So right there, that's the day that we finished with the cluster on the Nasdaq 100. The VIX was pretty high. It was at 30. We're at 3019. It finished at 3011 that day, Well, the VIX relative to 3M, VIX 3M, which is the 3-month VIX, we were at 115%, and right now we are below 95%. So what that tells you is the VIX is high. The VIX is high now as it was then. If you look at the ranges for volatility, here, again, compare this to where we were at the fourth quarter of 2018 when we were kind of hitting the fan right there. We were pretty high there. We were at 2.5%. You can see if you look down at the bottom, the ATR was at 6 points. But again, relative to where the index was at the time, that was about 2.5%. Well, look over right where we're at right now, all the way to the right, we're about at 2.5%. The VIX, the ATR down there is at 10 because the price is different. The price is at 400 instead of 250. But still, you're at 2.5%. You're pretty high ranges. We're as volatile now as we were then, but the VIX is as high as it was. The VIX is high as it was then now, but the VIX 3M, that's the kicker. The VIX 3M is at 32 now. If you go back to that December 21st of 2018 right there, the VIX was at 26 there. So it was at 26 versus 32, which means that there's more demand now than there was then for long-term protection, 90 days, not just 30 days, not this short-term immediate protection, but long-term protection. Back then, in 2018, the VIX was at 115% relative to the VIX 3M. The market thought this is going to be over very quickly. We just need the very short-term protection in case things go haywire in the very short term. But within 90 days, we should be bouncing up really nicely. And they were correct. Within 90 days, you were bounced up. The market's bounced up. Within 3 months of by what would that be? January, February, March 21st. I mean, that's where we were. So they were correct. The market did bounce 3 months later. The market's not expecting us to bounce 3 months later right now. The market's still very much. In fact, there's more demand for 90-day protection than there is 30-day protection because the VIX 3M is higher right now to the tune of 95%, right? The VIX is at 95%. So when people tell you that, man, we are so bearish, we're washing out right now, that would be true if the VIX was up here at 125%. It's not even at 100%. It's not even above 95%. See, this is neutral territory for the VIX, right? Anything above 95 is bearish for risk appetite. Anything below 90 is bullish for risk appetite. So we're in the neutral zone between 90 and 95%. We're not even above 100, much less 105, which is typical for any intermediate decline, a pullback, right? 115 to 125, you're looking at like market sentiment decline and death cross environment, which obviously we are in a death cross environment. We are in a correction mode. The market, the 50 days below the 200, and we are below the 50-day moving average. So we are in correction mode, and what the options market says is we still have this much left to go, and it might take 90 days for it to work our way up and down into that area. So that's why the VIX 3M is so high now compared to back here, where on December 21st, you were pretty much that close to the 200 week. The market thought, okay, we're pretty much done. I mean, yes, there might be some short-term moves, and there was. Then the very next day, you notice it was a pretty big down day. That the very next day, on Christmas Eve, no less, right there, right here, we were down another 2%, down 2.6%. So the market still, we're down the next day. But after that, the market rallied 5%, and it was up from then on. So the market was, it was correct not to expect long-term declines because you only really had one more day of declines left. That's how close you were to being done. This is how close you were, right where my cursor is. That's how close it was to the blue line to being done with its correction. It got there the next day. This is how close we are now for the correction being done on SPY. Now on IWM, we are actually pretty close. That's how close we are. Very similar. So IWM has got a very good margin of safety. It probably will come down towards 170, I think, by the time it's all said and done. So it might go to that 50% retracement where that layer of volume, that shelf of volume support is, and then where these old highs are. So that's probably most likely where you'll end up going on the Russell. And then you can see the Qs. That's how much. You still got the whole Fibonacci retracement zone between the 38 and 62% levels to get to where the 200 week is. And there's not very much volume to get to that level. There's not that much volume below it, right? We might get all the way down towards 231 in the worst case scenario, if not 217. I think that would be worst case. I think it's pretty good likelihood we stop around 258, 260 in that spot. So let's take a look at some of these other oscillators. If you look at the DMI, it's still bearish. We're still above 25. We're still below 20 on the positive indicator. Same thing on the Qs. And if you look at the weekly version of these, I mean, they're very bearish, right? The ADX is strong. We are in a trending mode right now, on a long-term trending mode. You're back to a very mature trend strength on SPY. If you look at the Qs, same thing, mature trend strength. IWM almost below -5. Again, you look at the weekly versions of this, and we have a very mature trend, long-term trend strength on IWM. So the long-term trend is very mature, bearish, and we're almost there on the Qs, and you're almost there on SPY, right? So we have an intermediate trend strength going right now in SPY on a weekly chart. That's about all we got to in 2018. If you look at like 2007, that first correction there, we did get up to right around above 80 and below -5 on that initial correction before we failed. So we can get to pretty strong bearish levels. COVID did, but COVID was so unique. I wouldn't compare anything to the COVID drop again because that's how rare that type of move is. But we do have a strong trend, and we're almost through the cloud, right? That cloud, the bottom of the cloud acts as a support. So in the short term, I think we'll bounce this week. But we get through the cloud, and you're in correction mode. You can see we got through it there. We got, there's the fourth quarter 2018. There's COVID. There's 15, 16. There's 2011. When you're in correction mode, you get through it. When you're in a bear market mode, when you're in correction mode, you get through it. When you're in bear market mode, you never get back above it. Right, so you get back up. You never did get back above it there, and we kept going down there in 2008. If you look at going further out to look at the other bear market over here, you can see. So the correction got us down below it, and we never got back above it. So we just stayed down the whole time. That's a bear market. So that's right now we're not even below it yet. We're not, we get down below here to this 38% retracement, which is where I think we'll get to ultimately, at least, if not further down towards 3,500, I think is ultimately where we'll finish dropping. That's where the 200-week moving average is. But at least it's 3,800, you'll be below the cloud. Then it'll be a matter of when we bounce, how far up do we go, right? Do we get back up above the cloud by the time we bounce? Whether or not, you can see you got, within a few weeks, you're right back above the cloud with COVID. Just a few weeks, you were right back into it, right? In 2011, boy, that really zoomed out. Let's zoom. So there's COVID. So 1, 2, 3 weeks, you're back in the cloud. With 2018, you were 1, 2, 3, 4 weeks, you're back into the cloud. In 2016, you can see it didn't take very long to get back to the cloud, about 6 weeks, and you're back in the cloud. Same thing in early 15. It's kind of a combined. 2011, it took about 6 weeks or so, but you never really extended too far away from it there or in 15 and 16. In 2008, 7, you did kind of get pretty decently below it, and then when you bounce, you just never could get back above it. So that's the kind of danger we may be facing depending upon how low we go here. If you look at the whole moving average, which is another reason why I think we'll be rather bullish here this week, we'll probably start off with a gap to the downside and some bearishness early Monday morning, but by the end of the week, I think we'll actually have a positive week. Excuse me, I'm trying to keep the throat moist. So you can see like we did get the parabolic SAR to flip to the downside. We actually did get down to that low. We just didn't get through it to pop it up to the upside. So we still haven't really got the bullish move, right, where the parabolic SARs drop to the bottom. So I actually think that we'll probably push that up to the upside. The parabolic SAR will flip to the upside tomorrow. So, but the next time it does flip back down to the downside, then we will be bullish at that point. So I think any bearishness right now that we get on the Hakunashi candles, and the whole is actually still bear. This is a very long period for the whole to be bearish. It's past the 20 days, which is what it's based off of. So it's a really long period of time. It's very likely that we will turn back up right now, and the holes, and after a day or two of the parabolic starts flipping to the upside here, because once it flips to the upside, it's going to flip up to that level. Then it's going to drop really sharply as these highs drop. So then we'll then we'll end up flipping. We'll get some bullish Hakunashi candles. I think that will happen by the end of the week. We might even turn green on the whole by the end of the week as well. I also have been showing you the McClellan oscillator. You can see again until we got that really good move on Wednesday, but the McClellan oscillator was like, yeah, that's nothing, right? It's the same thing with the highs and lows. When you look at the highs and low index. Here, let's go to the highs and lows index. New highs, new lows. I mean, we're below 1,700. That's a really, really low level. We got down to that level here earlier this year when we kind of hit the very bottom. We got below minus 2,600. That's a pretty bearish level. Like it's not a bullish reversal anytime soon. The average is down below 780. So it's we've got to turn positive before things turn positive. The highs and lows have to turn positive. We have to get back above this average, and you can see when they turn positive is typically when we turn back up after being bearish. You can see all the low points here, all these correction. So let's see if and when we turn positive. We had a brief little move there. We never could get though. If you recall, we were talking about it then. We could never get above 100. We got to get above 100 for it to really be bullish. And we never did. We never did any of these other instances either when we were quasi-bullish. So we need to get above 100, right? We need to get above 0, get above 100, then we'll feel really good. And you'll also need to see, for us to really have the low point be done, this has got to drop to an extreme low, below 50%. The number of stocks above their 200-day relative to how many are above their 50 days. So you go back to all the other correction low points that we've had. You saw the COVID drop. There's fourth quarter 2018, there's 15, 16, there's 2011. See, they all got below 50%, at least below 50%. And then, of course, there's the bear market. And there's the correction low that started the bear market, right? So all of these get at least below 50%. We're still kind of bouncing up, going up and down above the line. The line's still dropping. So until you get above the line and the line turns up and it stays above the line, then you're still on the decline. Right, especially until we get that big dip to the downside that we're just not getting right now. So we still got plenty of room to go on this correction, but that doesn't mean that we're not going to have near-term rallies, right? Which I expect the near-term line will rally this week. We might even get the intermediate line, like I said, to rally like this, right? To get up above market sentiment briefly, and potentially even get towards bullish territory. I don't know if it will I don't think it will do this kind of move again, this kind of rally, but I think it will do more like this kind of rally, where either you get up to 50 or just right above 40. It's barely above, but see there it stayed below the market sentiment line. Here you just barely got above it. I think it'll be more like this because of how low market sentiment already is on the S&P. One quick little move here, chart to look at. You can see we had a lower high and a lower low on Friday. We did finish above yesterday's or Thursday's low point, as well as finishing pretty much right at last week's low. So we didn't, it was, this week's low point was actually on Monday, so it was a lower low. This week's high point was a slightly lower high, just barely, and then we finished above last week's low. So again, not very bearish. So this week we kind of halted the declines, and I think we'll probably trade up into that range, at least into this range of these high points up towards 429. We'll probably start down here and maybe even go down in the morning on Monday, but I think we'll rally by the end of the week and finish, this is Monday, Tuesday, Wednesday, finish up towards this area, towards the highs of the week, right? And probably fill in that gap. I think that's a common gap. I think both these gaps get filled in by the end of the week. So what do you think? Do you agree with that assessment? Do you disagree? Let me know in the comment section below, especially if you disagree. What charts or indicators are you looking at that will tell you why you're either a lot more bullish than I am or a lot more bearish than I am. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That notifies you when our videos are posted. Also, while you're down there, hit that thumbs up icon. That tells us two things. One, you liked your video today. And two, that you want us to do another video again tomorrow or Monday. Quick way to give us feedback if you like our stuff. Of course, if you don't like it, you don't have to click on anything. You don't even have to watch if you don't want to. Also, while you're down there, comment. What did you get out of the videos today? What stood out to you? What questions or comments do you have? Post those in the comment section below. Join our website at marketscholars.com. There's a link popping out up there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content between the videos from day to day. There's my handle at DavidSettle42. And join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, check out some of these other things on the right-hand side. If you click on Market Outlook Live, this icon right here takes you to our Market Outlook Live page. Market Outlook Live page. I do these on Monday, Wednesday, and Fridays at 3:30 Eastern Time. I do a live video here on this page, about 10-15 minutes long. I take a look at all the trades we've done in prior Market Outlook videos, because we always do a trade at the end, right? We see whether we should stay in them, get out of them. We also already put on today's trade idea before the market closed here, so this is where you can check out all the archives as well. Again, you can also get to it by clicking on Live Trade Review in our Market Outlook category. Come down here, you can see our upcoming classes for this upcoming week. Click on View More to get the full calendar with all of our classes going forward for the month, and then all of our classes going back for 4 years. We have recordings of those. Come down here, click on that heart. It opens up this tab. Hit that like button. Again, same thing. Click on this thumbs up icon. It takes you to this page. Click on that like button. Again, the more you do that, it helps get our content out to more of our followers because of the all the likes and retweets and comments. So the more you do that, it really helps us out. That's why we always ask. It also helps you out because Twitter and Facebook promote content in your timelines from the accounts that you engage with the most. So we try to make it really easy for you to engage with us right here while you're watching. All right, now let's take a look at what's driving the price action here this week. And you see commodities are still the strongest performer over the past 3 months. The dollar and gold. So these are not three things you typically put together, right? The dollar continuing to be a very significant outlier to the upside. And you remember, again, a lot of it's that strength, the weakness, in the euro and the yen. These two currencies which are down the most. The pound's also been down here lately too. Those three currencies are three of the biggest currencies. And in fact, the euro and the yen by themselves make up 70% of the dollar index. So the fact that they're down against everything, including the dollar, again goes to show. You can see the dollar is actually pretty flat against the Canadian dollar and the Mexican peso, which are two of the bigger currency weightings in the trade weighted index. So the dollar is really not that bullish. It's just really bullish against these two, these European currencies, and the yen especially. 13% is such a big number that it's making it such a strong performer on a relative basis that you're seeing it up here with gold and with commodities, which is not very common. Usually commodities and gold, when they're rallying over equities and bonds, that's very inflationary, right? That's the inflationary aspect, with bonds down as much as they are and gold and commodities up as much as they are, again, relative to equities. It's very inflationary. Inflation is typically bearish for a currency. And obviously you can see it's not, right now against the dollar, because you have other currencies with their own issues that are more bearish than the dollar is lifting it up. You can see the trade-weighted dollar has been, pretty bullish for most of the year, pretty flat since November of last year, for the past year, Since November last year has been pretty flat until just now, like this last week or so, a couple weeks, the dollar has really taken off too against these other currencies, like the other currencies that are bigger weightings in the trade weighted basket, right, versus the dollar index, the futures contract, which is what you hear quoted quite a bit. That's not a trade weighted basket. It's more, what other currencies are very liquid, highly liquid out there. The euro being the most highly liquid and the yen being the second most. That's why there's such bigger components. But you can see here, the dollar was actually down for most of the past 3 months. And if I were to go out to 6 months, so to go back to kind of closer to that November time frame that we just talked about, you can see again the dollar is pretty flat against a lot of these. The Mexican peso is actually up against the dollar for the last 6 months, and the dollar is barely up against the Canadian dollar, and then most of those gains came in the last few weeks. The Australian dollar had most of its losses against the dollar in the last couple of weeks. Same thing with the Singapore dollar there, and you can see a lot of these currencies in the last couple of weeks really dropping pretty hard against the dollar. But before then, the dollar was pretty flat for 6 months. So not nearly the only reason why it was as bullish as it was is because the euro and the yen and the Swedish krona, which is one of the 6 currencies in that US dollar index, was also pretty bearish too. But of course, bonds is the big one. Bonds prices typically lead stock prices. Bonds are remember the S&P is like right here. Like if you were to compare where the S&P is compared to bonds, the S&P is right here. This is barely below the 60, Fibonacci retrace, the 50-week moving average is barely below the 23% retracement. I mean, that's about where we were going into the beginning of 2021 on bonds. And then bonds made its way down to this with a big gap, it made its way down to the 200-week moving average. It bounced up towards the 50, made a couple of attempts to get really going here at the end of 2021, and then failed, right? And now bonds are in a bear market. All these moving averages are well below. In fact, the MACD for bonds is as low as it's ever been. For TLT is as low as it's ever been. So this is for the ETF since it's been in existence, however long it's been in existence here, going back to 2002. This is the lowest the MACD has ever been on the weekly chart. So the bond market, which again, bonds typically lead stocks. All of these bear markets and bonds preceded the corrections that we saw in the stock market. This one here preceding the 15 and 16 one by about a year and a half. And then there's the one that preceded 2011. There's the one that preceded both 2018 and COVID, which ended up over here. And then now, this is deeper and bigger than all of those bear markets were. So this is pretty significant in terms of the bearishness. And then again, kind of what can we expect? Remember, the far end of the risk appetite scale is well below in bear market. ARK Investments is in its own bear market. Bitcoin, which is something else we look at on the far end of the risk appetite scale, is well in the correction mode, right? It had the pullback and it bounced and didn't fail. Then it had another pullback and bounced and did fail, right? So it did bounce here and failed, and now we are in correction mode. And again, breaking 36,000, wherever that Fibonacci line is 50% Fibonacci line, which is there at 36,782. I mean, we're at 34,000. Down 5% here so far in the futures trading. You can see there's most likely Bitcoin's going to make an attempt at 29,000. The problem is there's going to be Fibonacci support there, but there's no volume support. We moved up so fast at the end of 2020. We went from 18,000 up to 40,000 in a matter of a couple weeks. It left nothing to hold it up, right? Except for this Fibonacci retracement zone. So we'll see if 29,000 can hold as we work our way down. If not, you can see you expect that it would correct like ARK Investments did. If not, go through and go into its own bear market and work its way back down to this 12,000 area where there is some volume as well as these old high points. So again, the S&P would be probably the last. In fact, your really safe haven areas like your dividend investments, you can see they haven't even pulled back yet. They're just in a pullback right now. They haven't even failed yet a pullback bounce. So that kind of goes to show they're still a long ways, and there's not nearly as big of a gap between the 50 and 200 day move. It's a pretty sizable move, but it's not nearly as big of a gap as it is on say even the Qs still right now. To get to the 200 week moving average, and you're already about halfway there, right? 259.60 out of 309.25. You're still 16% away from getting to the 200 week moving average, and you're already halfway there. That's still a pretty decent move. The dividend investment stocks, these aristocrats, kind of give you an idea of why it's good to be in those stocks. during this kind of market run. To get down to 102.63, which is where the 200-week moving average is, it would be about an 18% move to get to that point. And again, we haven't started, so it kind of goes to show that from top to bottom, this will be a far less smaller move to the downside than a lot of those other riskier asset classes. Let's take a look at the dollar UUP. So UUP has also been in a parabolic move to the upside right now. It's not, the strongest. It's not the strongest it's ever been, like bonds are, but it's pretty darn close. And like I said, we are really going parabolic to the tune of its directional movement index being really high, right? It's like the positive got above 50 on the daily indicator. The weekly indicator got up above 40 here, and then the negative index is down below 10. Again, just for some perspective on this, you can see we did go parabolic there from mid 2014, but we were coming down from 21 there and made our way all the way up to 26. That's the last time we were this bullish. To kind of give you an idea, that was the middle of 2014. If you go out to see just how what kind of move that was and why it was so big. Let's go out 20 years here. And then go to UUP. There it is right there. We had been in the bear. The dollar had been in the bear market pretty much for years. We had been below the 200-week moving average. The 50 had been below the 200-week moving average for years, and then we rallied up to the upside. If you were to look at the euro US dollar as a proxy for the dollar index, there we are going into 2014. The euro hadn't been too bullish itself, but it had a good little run right there, and then boom, we dropped that far. The euro dropped. So again, looking back at the UUP, which remember is a basket of index, that we had been so bearish for so long that it made such a big rally. That we were kind of bullish, not for years, but we were kind of in a bear market here on the dollar for a half of 2020, for most of 2021, until this last little run up. And now we are higher now than we were in 2009, and almost as high now as we were at the worst of the COVID low. So it and then like I said, going parabolic kind of goes to show just how strongly bearish we are, or bullish we are, how parabolic we are. The RSI getting up to 80. Look at the weekly RSI. Again, you have to go back to 2014, the last time we were this bullish, and that was kind of an anomaly. The other periods were here in 2010. And then 2008, this is more like, that was more of like a COVID anomaly, that type of move you wouldn't see again. And these are kind of more typical of what we're seeing right now. And this goes to show what happened there when we got those kind of moves. You'd expect very similar. In fact, the CCI tells you there's a tremendous divergence going on right now from this high point up to that one. You would expect a move if I were to remove this drawing and put on a new Fibonacci retracement zone from the lows up to these highs. If this were the peak, the divergence would tell you that you'd be expecting a low point to about towards that 38% retracement level. Now, granted, that's not going to happen tomorrow, and it's probably not going to happen this week, because the first thing you got to see before that happens is that MACD to get below its moving average, which it's just barely doing, right? The small red arrow right there, and for the dollar to get below its 17-day moving average, and that hasn't even come close to happening yet. But when it does, you can see there's not very much volume below it, because you moved up so far so fast last couple of weeks. It's very easy to go down just as far and just as fast because there's no volume there to support you all the way down to that 38% retracement level. Let's take a quick look at how the sectors are shaping up here. So let's come down here to the sector comparison chart. You can see the energy's really been taken off the last 3 months. But let's look at how they performed here this week. Relatively down week. So energy, it was up 10% this week. The S&P was flat. Real estate was down. Discretionary was down. Staples, so all consumers were down. Everything else is pretty, not very much movement in one direction or the other. Utilities were up, and real estate was down. So your interest rate sensitive sectors ended up on opposite ends of the spectrum. Technology and communication services and discretionary were really bullish post FOMC, but then they fell really hard and kind of came back down to earth along with the rest of the market. And utilities ended up being strong. But look at energy. Energy is like, we don't care about what all y'all are doing. We're going to do our own thing. And energy continues to be on its really good run. Remember, energy had been so bearish for so long. Now it's just like, again, going parabolic. Let's go out 15 years. You can see the bear market that energy was in. Brief little bullishness there in 2018, but for the most part, energy has been in the bear market. Since the dollar took off in mid-14, that put a lot of pressure on the energy sector. It's been in the bear market ever since and really hit the fan with COVID. But since then, look at that parabolic move coming off of those lows all the way back up to these old peaks on an absolute basis. On a relative basis, it's nowhere near those old peaks, right? On a relative basis here, you can see we're back to 2019 highs, early 2019 highs. There's your 2014 highs. We're only about halfway there on a relative basis. So it's nice that XLE, has gotten back to these levels and close to these levels here. That just barely getting past those 2018 highs there, but that's on an absolute basis. On a relative basis, those 2018 highs are right there. So we're still got some room to go up. And again, going parabolic, and the PPO as high as it is, the RSI, the CCI, the DMI, the RSI diverging at these really high levels. So it appears that that energy appears to be peaking at this point, and wondering when it will ultimately start to slow down the pace. Not necessarily go down, but more than likely come back down to these moving averages because you're so far up above them. Anytime you diverge away from them as far and as fast as you are, and as I said, when you look at these charts here on the daily chart, when you move up so far so fast, there's no volume below you. It's really easy to go down that far that fast. And then you can see these shorter moving averages are all really sitting on top of each other. It's a great move the last couple of weeks coming off a low, but we had dipped below the 50 days, so we've already started to show signs of a pullback, right? Breaking that 50-day and working our way towards the 200. Now with that, especially with the gap, that gap between the 50 and the 200 is really wide right now. You have to go way out here. Zoom out here to longer time frame. It's the biggest in the past year. It's almost the biggest in the past 5 years. You can see coming off of COVID, you had this big of a gap, and look how it only took a few months to fill it in, from June 2021 to September 2021. And so if we're going to be broadly risk off, then you'll see the energy sector kind of do the same thing right now. You would expect that it would do something very similar there. Again, 2007, 2008 gets brought up a lot because of how bullish it was in that bull market. So this was, remember, the correction for the broader S&P 500 started in early 2008, and then we had the failed move higher. So the S&P corrected here, and we did drop between the 50 and the 200, and the gap wasn't nearly as big. So energy will decline while the market is in a correction, and you notice it hasn't yet. So that's the last shoe to fall. Then what happens is the market will bounce back up off its correction. For energy, it'll bounce back up, off of a higher low point because it's been so bullish, and go up to potentially a higher high point while the broader market fails potentially if we do go into a bear market. So that's kind of what happened in May of 2008, right? The S&P 500 over here, right here, the S&P 500 failed at a lower high point. Energy went up to a higher high point. So, but it did correct. It did come down to this 200-day moving average when the broader market was correcting. So you'd expect the same thing. If we are in correction mode in the broader market, everything goes down in a correction, in a true correction. You'd expect that this will eventually come down with it. All right, so for our trade the other day, I want to take a look at Lockheed Martin. Lockheed Martin's had a nice little near-term rally up into the upper reversal zone on the near-term line, up to the 30-day moving average. We'll see if there ends up being some resistance. The intermediate posture is obviously still in bearish territory, even though it's rising. If you take a look at like the weekly candles here for Lockheed Martin, you can see we got some bearish candles. We did get a green arrow this week and got a little bit of an upper shadow, but you're in a kind of a bearish mode right now. You're that close to red. I mean, we just barely had a red candle. The PPL is falling. You have a negative differential. When you look at the 3 green arrow chart for the stock basically has rallied back up. We had a pullback. Now the question is whether this will be a failed pullback bounce and start a correction, or start this little correction in terms of filling in the gap between the 50 and the 200-day moving averages. We know why it rallied so much because of the Ukraine situation. We got that long upper shadow. We retested that range. We didn't close above that high though. There's some resistance there. We ended up coming back below the 17-day moving average. We have 1 day currently up above the 17-day moving average, right between the 30 and the 50. So we either break up above this with the green arrow on the MACD, the stochastics, or we hold resistance at this volume node and then start to fill in some of this gap between the 50 and the 200-day moving average. That's the expectation. Obviously, the nice thing is that we'll know really quickly if it doesn't do that because we're that close to those moving averages. We had a positive. The negative directional index got above 25 barely, but pulled back. Still is above 20. The positive got below 20 and is still so far stayed below 20. So it's not very positive of a bounce there when you look at it from that perspective. We're up above 50, but we're not getting back above 60 yet. We're kind of in that kind of wishy-washy zone between 50 and 60 where it seems like we're bullish, but not quite. Same thing with the CCI down there at the bottom. Looking at the Ichimoku cloud, we basically filled in that little dip that we had. This dip over here, we filled that in on the cloud. We got back above it. We're not back above the blue line though, so we're still below that blue line. So that's an element there. And you look at like the Bollinger Bands here, and you can see, again, we are in the upper half of the chart, but not really into that upper quartile above the 75th percentile to where we're back to being bullish again. So there's opportunity for this to kind of to be bearish. And like I said, we'll know really quickly if we're not. So what we decided to do here was to do a bear put spread where we bought the 415, sold the 410, filling in that gap between the 15 to 200-day moving averages. You can see it's a pretty aggressive trade. I got a little flexibility, but it's a pretty aggressive trade. We're down a little bit since we got into it with where we were priced into it. So we're only down about $76. The max I can lose is 500 by getting about a 4-to-1 reward to risk ratio. If it does work out, getting back into this area, back towards that 40-week exponential moving average. I showed you that the daily chart on this. So the weekly chart, to kind of give you an idea of what that looks like, we are above the 8. The MACD is below its moving average. We are back above the 8. You would expect that we'll get below that 17 and start to work towards the 30 and the 50 week at the very least, where that volume support levels will be. That's the expectation based on the pattern, the trade that we're doing there. All right, well, that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link that's popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread there with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Also, you can subscribe to our website at Market Scholars for free. Like us on Twitter and Facebook. Those go a long way for us. We really appreciate those that click those thumbs up and the hearts. So keep on doing that. Have a great rest of your weekend, everybody, and we'll see you all next week.